Imagine this. You wake up one morning, make a cup of coffee, and before you even open your laptop, a notification pings, $3.12 dividend payment received. No work hours logged. No meetings. No boss. Just money, flowing in while you sleep. That's the dream of every investor chasing financial freedom. But what if I told you there's an ETF, a single investment fund, claiming to pay dividends as high as 28%? Yes, you heard that right, 28%. That's almost double the average salary raise in America, and way more than most rental properties, savings accounts, or bonds could ever offer. It's the kind of number that makes you stop scrolling and think, wait, can this really replace a full-time income? In today's video, we're breaking down the truth behind this high-yield dividend ETF that's been making waves across YouTube, Reddit, and financial blogs. Is it really a golden goose for passive income, or just another trap hiding behind glossy marketing? We'll break it down step by step. What this ETF actually is. How it generates such massive dividends. The real math behind those payouts. And whether it can actually sustain a 28% yield, or if that number is just a dangerous illusion. Stay tuned till the end, because we'll also calculate how much you'd need to invest to replace an average American salary, and whether it's even realistic. Let's get started. The temptation of high-yield ETFs. Dividend investing has always had this aura of safety. It's the sweet spot between growth and income. You own shares of real companies, but you also get a consistent cash flow. In a world where the average savings account pays less than 0.5%, a dividend ETF paying 28% sounds like magic. But behind every high yield lies a question: what's the catch? To understand this, let's start with what a dividend ETF really is. An ETF, or exchange-traded fund, is basically a basket of stocks. Instead of buying one company, you buy a slice of many, spreading your risk. Some ETFs focus on tech stocks, others on energy, and some, like this one, on dividend yield. Now, the ETF in question is often marketed around the idea of monthly cash flow. You put in, say, $10,000, and every month you get a juicy payment, maybe $200, $250, sometimes even more. It feels like your portfolio has turned into a mini paycheck machine. And it's true, some ETFs genuinely offer double-digit yields, especially those using covered call strategies or investing in high-yield debt instruments. But here's the problem: yield doesn't always mean profit. Many high-yield ETFs are essentially trading future growth for present income. They generate income by selling call options, meaning they limit how much they can profit if the underlying stocks rise. It's like renting out your potential gains for a quick buck. And that brings us to the heart of the issue: when a fund promises a 20% plus dividend, it's not necessarily making you 20% richer. Sometimes, it's just returning your own capital, slowly eroding the value of your shares. In other words, it's like cutting off pieces of the golden goose every month just to get eggs faster. How the 28% yield really works. Let's break down the mechanics of how a 28% dividend yield can even exist. Take for example an ETF like SVOL, JEPI, or QYLD, all of which use covered call or volatility-based income strategies. These funds collect option premiums, money earned by selling the right for someone else to buy the ETF's holdings at a set price. Think of it as renting out your stocks. The renter, option buyer, pays you a fee, and that becomes part of your dividend. When volatility is high, like during market uncertainty, these premiums can skyrocket. That's how a fund might suddenly report yields in the 20 to 30% range. But here's the catch: those yields are based on trailing 12-month distributions, not guaranteed future income. So if the market calms down and volatility drops, the income stream can shrink dramatically. Even worse, some funds will dip into their net asset value, NAV, the fund's actual capital, just to maintain those massive monthly payouts. That's not profit. That's like withdrawing money from your savings account and calling it income. It's an illusion, and it works, until it doesn't. Let's do some simple math. If you invest $10,000 in a fund paying a 28% annual yield, that's $2,800 a year, or about $233 per month. Sounds great, right? But if that yield comes at the cost of the ETF losing 15 to 20% of its share price each year, you're not winning. You're just liquidating your own capital slowly, disguised as dividends. In reality, many investors who chase ultra-high yields end up with portfolios that look busy, with constant cash flow, but actually lose value over time. That's why understanding total return, not just dividend yield, is key. Because if the ETF pays you $2,800 but loses $3,000 in value, your income is just a mirage. Can it replace a full-time income? Let's test the dream scenario, replacing a full-time job with this 28% ETF. The median U.S. salary is around $60,000 per year, or about $5,000 per month before taxes. If the ETF pays a 28% yield, here's the math. To earn $60,000 per year, you'd need roughly $214,000 invested. That's the headline that grabs people's attention. You can retire on $214,000. But that assumes the 28% yield is stable forever. The fund doesn't lose value. There are no taxes or fees. In reality, none of those things are true. Let's consider taxes first. Most high-yield ETFs distribute ordinary income, not qualified dividends. That means you could lose up to 37% of it to taxes, depending on your bracket. So your $60,000 might actually be $38,000 to $45,000 after taxes. If the ETF pays a 28% yield, here's the math. To earn $60,000 per year, you'd need roughly $214,000 invested. That's the headline that grabs people's attention. You can retire on $214,000. But that assumes the 28% yield is stable forever. The fund doesn't lose value. There are no taxes or fees. In reality, none of those things are true. Let's consider taxes first. Most high-yield ETFs distribute ordinary income, not qualified dividends. That means you could lose up to 37% of it to taxes, depending on your bracket. So your $60,000 might actually be $38,000 to $45,000 after taxes. Then factor in potential capital erosion, say, a 10% drop in NAV per year, and you're down another $21,000 in lost value annually. Your real income shrinks fast. The truth is, sustainable income isn't about the biggest number. It's about consistency. A portfolio yielding 6 to 8%, compounded with growth, will likely beat a 28% yield that keeps eating itself alive. So, can this ETF replace a full-time income? Maybe for a few months. But for decades? Unlikely. In fact, most retirees who depend solely on high-yield ETFs end up doing capital drawdowns, slowly selling off shares, to maintain their lifestyle. That's not passive income. That's liquidation. Why these ETFs still attract so many investors? So if they're so risky, why are these high-yield ETFs so popular? Simple, psychology. Investors love seeing cash flow. It feels real, tangible, and safe. Even if the fund's price drops, the monthly payment gives a sense of control. It's the same reason people prefer rental income over paper gains, the feeling of earning. And ETF marketers know this. That's why they design products that promise monthly payouts. Because emotionally, it feels like a salary. Even the fund names are crafted to sound stable and reliable: Income Opportunities, Yield Max, Monthly Pay Fund. But the harsh truth is, financial safety doesn't come from what feels safe. It comes from what sustains over time. Many investors end up confusing distribution rate with profitability, and that's exactly how these ETFs keep drawing in billions in new capital every year. It's financial marketing at its finest, wrapped in spreadsheets and trust. Smarter income alternatives. If 28% yield sounds too risky, and it is, what's the smarter way to build real passive income? Here are 3 proven approaches. 1. Dividend growth investing. Instead of chasing massive yields, focus on companies that grow their dividends yearly, like Johnson & Johnson, Microsoft, or PepsiCo. These pay 2 to 4% now, but grow 8 to 10% annually, which compounds powerfully over time. 2. Balanced income ETFs. Funds like SCHD, VYM, or JEPI, moderate risk version, offer 4 to 10% yields with much better capital stability. 3. Covered call hybrids. If you like the monthly income aspect, allocate a portion to covered call ETFs, but balance it with growth ETFs like SPY or VTI to protect long-term value. The goal isn't just cash flow, it's sustainability. The verdict. So, can a 28% dividend ETF really outperform a full-time income? On paper, maybe. In reality, almost never. Because income that isn't sustainable isn't income. It's erosion disguised as profit. High-yield ETFs are like sugar rushes, they give you instant gratification, but often lead to long-term fatigue. If your goal is to retire early or replace your job, focus on a balanced portfolio that grows and pays, not just one that bleeds capital to keep payouts high. Remember, true financial freedom isn't about how much you earn, it's about how long it lasts. So before chasing that 28%, ask yourself, do you want to look rich this year, or stay rich for the next 30? If you found this breakdown helpful, don't forget to hit like, subscribe, and turn on notifications, because we dive deep into every new ETF trend, stock strategy, and retirement myth the internet throws at you. Drop a comment below, would you invest in a 28% dividend ETF, or do you prefer steady, long-term growth? Your thoughts might just make it into our next video. Until next time, invest smart, stay patient, and remember, the best income is the one that doesn't run out.